In the final part of macroeconomics, we will discuss the economic policies on achieving government objectives. So what type of economic policy to achieve government objectives? We discussed there are fiscal policy, there are monetary policy, and government will focus on trying to control several factors or the government objectives. First, the growth or the economic growth. Second, the inflation, that is the price level in the overall economy. Unemployment. Full employment is always an objective for a lot of governments in the world. And last but not the least, the balance of payments. That means the government would like to maintain a healthy trade deficit or healthy trade balances of payments with its trade parties in the world. And government will use a variety of levers. This includes just mentioned the fiscal and monetary policy. So let's go deep to see each of the objective one by one. Economic growth. So here we talk about economic growth. There are both fiscal and monetary policies to promote growth. First, running a budget deficit. It is the fiscal policy. A government could pump money into the economy, triggering increased aggregate demand. It is the concept behind the Keynesian economics. John Maynard Keynes agreed that the economy cannot be back into equilibrium without the government intervention. So government can pump money into the economy by increasing its expenditure or decrease its income in the economy in order to run a budget deficit to boost the economy by increasing the aggregate demand. Next, government could increase the availability of production factors. That means increasing the availability of labor through training schemes or importing the laborers from other countries to fill up the supply gap of those factors of production like labor. It is a kind of monetaristic view because it improves the supply side in the economy in order to improve the economic activity or to promote economic growth. Cutting interest rates. Government could intervene the market by cutting interest rates. That means lowering the cost of borrowing to boost aggregate demand. It can be interpreted as either a Keynesian policy or monetarist policy, because for Keynesian policy, the lowering the cost of borrowing, it helps to boost the aggregate demand, or increasing the money supply proposed by monetarist policy, because it can help to improve the overall borrowing costs in the market. And we have other policies. For example, here we proposed the government grants and incentive. These items can boost the investment, say, to protect the local market, because you have a target audience or target group for those government grants or incentives to be paid. That means those sectors in local market would like to invest more and to protect the market for local players. So next, we move on to inflation. Inflation is another government policy objective in order to achieve a stable price or stable inflation. And remember, we have different causes of inflation. We list 5 causes of inflation. And government has to understand what is driving up the general price level in the economy so they can find a solution on how to fix it. First, we have demand pull inflation. Demand pull inflation is driven by the demand of goods and services in the market or in the economy and the pace of the demand is growing faster than the ability in the economy to supply those goods and services. That leads to a price level up in the general economy. And next is cost push inflation. That means the production factors or the factor of production, the price is increased. So for the manufacturers, they have to increase the price in order to make profit, or even the worst case is to break even. That means running the operation without any loss. Otherwise, when the cost is higher than the price that you sell to the market, it's no point for the factory or manufacturer to sustain the operation. And third, imported inflation. For imported inflation, this can occur in countries that have significant levels of imports. In a lot of state, or what we call the state-owned economy or city-state economy, one example is like Singapore. It has very little or very minimum of natural resources by themselves, because it's a city-state that has lack of resources. So a lot of goods are imported from other countries into the city-state. The imported inflation is one of key concerns for, say, city-state government like in Singapore. And next, we have the monetary inflation. Increasing the money supply, that will increase the purchasing power of the economy. It boosts the demand for goods and services. But if this expansion occurs faster than the expansion in the supply of goods and services, inflation can arise. That means you print a lot of money in the economy, which the printing rate is much faster than the goods supplied in the market. The overall goods and services in the market is less as compared to the money supplied. So in terms of money, you have to use more money to buy the same goods and services. Then it will turn into the inflation in the overall economy. And the last point or last causes on inflation is expectations effects. Many individuals and businesses will have an expectation that goods and services will increase in price each year. For example, I expect the overall general price level for next year may be increased by 2% or 3%. That's the expectation. It's not real. They just the people's gut feeling or their experience learned from the past. There's around 2 to 3% annual inflation. There's the expectation formed in their mind. And to protect them against this price increase, they will argue to their employer, say the wages should increase up to by say 2% to 3%, because they expect the overall price level will be increased by this amount. So they would like to keep their purchasing power the same on a year over year basis. So it's the expectations. At the end of the day, if they find the annual inflation is over than what they expected before, say from 3%, maybe going up to 5% this year, they will change their mindset on the expectation that the annual inflation right now is no more 2% or 3%. Right now it's 5%. So they will ask their employer to increase their salaries or their wages by 5% in next negotiation about their salaries and wages. The expectation effect will have significant impact on the overall price level, because if everyone in the economy or in the society have the same mindset, the overall inflation on next year is 5% instead of 3% in the past, then the overall price level will be changed or will be affected, because many people would like to ask for higher wages in the future. So here are five causes of on inflation. And next government objective through the policies that they would like to achieve is unemployment. Many government objectives would like to set the economy is at full employment. So if they have the unemployment issue in their economies, they will have several policies in order to solve the unemployment problem. But reducing unemployment is complex. Government needs to identify what type of unemployment it wants to tackle. And there are 5 types of unemployment. First, the cyclical unemployment. Cyclical unemployment is caused by the aggregate demand in the economy being too low to create employment opportunities for everyone that wants a job. So it is a typical Keynesian problem that we'd like to solve, because the aggregate demand is very low, and for Keynesian, the way to solve it is to increase the government spending or running the budget deficit in order to stimulate the economy by the government intervention. So it's a cyclical issue that is not permanent. So just right now, the business cycle is at the bottom. The government intervention can help to smooth or to solve part of the problem, and the economy can boost again after the government intervention by the government spending, increasing the government spending. And next is fractional. Fractional unemployment means people who are short-term unemployed as they are moving between jobs. It is in general not normally, it is not seen as a problem because just the transition period. And either the Keynesian policy, the Keynesian view, or the monetarist view has no solution on fractional unemployment. And the third one is structural or technological unemployment. It occurs when there is a structural change in the economy, leading to a change in the skills required and the location where economic activity takes place. So it is not a short-term change of unemployment. When the unemployment observed, there's some structural problems. Say, in the past, the internet is not so popular in the world, and right now there's internet, so a lot of jobs can migrate from one country or one stage to another, because, say, for example, the difference of wages or difference of skills. So the employer can shift some of the tasks or jobs from one place to another. Then for those jobs lost in a place, then it caused the structural problem or structural unemployment. For Keynesian view, for John Maynard Keynes' view, it does provide a solution on it. It does not provide a solution on it. So, but the solution can be found through the monetarist, because like the training center proposed by the government or built by the government to improve the skill set of the citizen in the state or in the country can help to improve the structural unemployment problem. So it's more on the supply side economics view on solutions on structural unemployment. And fourth causes or types of unemployment, the fourth type of unemployment here is seasonal. Seasonal unemployment occurs naturally in some industries where demand for goods in highly seasonal, for example, like tourism and farming. In some countries, farming is not allowed or it's not probable in winter time, say. So there is a winter time, farmers or the laborers in the farming industry have to go to other industry because it is impossible to do farming in the winter time. So it's a seasonal unemployment. And in other industry like the tourism, say maybe by the year end, the calendar year end, like in December, is a sudden increase in the demand for salespersons because there's a high level of retail activities in December, just in the holiday season. But after that, maybe in February or March, the demand for those salesperson is not so high, then it creates a so-called seasonal unemployment in February or March, because there's no need for the huge amount of salespersons for the retail market, because it's no more a holiday season. Then it's a seasonal factor or seasonal unemployment. No matter Keynesian or monetarist, they have no highlight on it. But on the supply side, like in the monetarist, the government can do is to improve the market imperfections. So there's some incentive for employer to hire the people, like in the short term, like maybe in the December time, they are going back to the retail market, but in March or February, they can have some other temporary jobs, say in production or manufacturing. That can help to solve the seasonal unemployment problem. And the final types of unemployment here is about the real wage. Real wage unemployment can be found in industries that are highly unionized. There's a strong union in industry, and the union negotiations keep wages artificially high using the threat of industrial action, such as strikes. And the high wages creates the number of people employed by the industry is reduced, because the employer, they cannot find any benefits by hiring so many staff in the company, because the overall wages is too high. So the employer would think out of the box by how to reduce the number of employers or number of staff, say by introduce more automation work or any other means of solutions to solve the cost issue. And for supply-side economists would see this as a market imperfection and would look to reduce the union powers or even abolish minimum wage agreements. So it helps to reduce the real wage unemployment. Another government objective to achieve is balance of payments. Government has concern if its balance of payments is deficit for a long period of time, as the country is running out of money. And to solve it, it has two main strategies that can help to reduce any balance of payments deficit. First, the expenditure reducing strategies. The target of it is to reduce the overall expenditures in the economy or from the population. Next is expenditure switching strategies. That means to switch the expenditure from one kind of consumption or products to another. So let's go into details on them one by one. The expenditure reducing strategies. These strategies involve the government deliberately shrinking the domestic economy, so that the government has the intention to shrink the domestic economy so it can help to reduce the demand for imports. And the reduction could be accomplished by, first, contractionary monetary policy, and next is running a budget surplus. In other words, these two policy, no matter it's monetary policy on a contractionary basis or running a budget surplus, the government is taking money from the economy, no matter it's for local consumption or for consuming the goods from imported into the country. So it's just the intention to shrink the domestic economy in order to achieve its target, to reduce the balance of payment deficit. Sometimes it works, but it hurts a lot to anybody in the country, because anyone in the country will be suffered by this economic downturn. So it's just a thought about how to reduce the expenditure in order to decrease the deficit, which is not very smart. So it comes to another strategy called expenditure switching strategies. These strategies involve the government to encourage consumers to buy domestic products or domestic goods rather than imported goods. And these strategies can be summarized by 3 different ways to do it. First, controls on imports via tariffs or quotas. It means that the government has some restrictions on imported goods. It can be by tariffs, let's say imposing any custom duties, for example, on any imported goods if we would like to protect like the farm products, or set any quotas for imported goods. And next, if the government does not have any restrictions on imports, it can help the domestic exports by subsidizing them. So increasing exports can help to reduce the balance of payment deficit. Remember, the equation on GDP is consumption plus investment plus government expenditure and plus the gap between export and import. So when it helps to reduce the imports, it helps to increase the overall GDP as well as reducing the balance of payment deficits, or it improves the export. It can help the government to achieve the objective as well. And lowering exchange rate, it definitely helps to increase the exports because it looks more cheaper from the foreign buyers on our domestic goods. And for domestic consumption, the people, the population will find the imported goods will be more expensive because the change of the exchange rate. So here is switching the expenditure from consuming imported goods to domestic goods. It helps to reduce the balance of payments deficit. And question time, the in-class question. In this class, I would like to discuss with you 3 questions. So it can help you to think about how to answer the exam style questions from this practice. First question, there are 5 statements which is about unemployment. So your task is to identify which of them is classified under which kind of unemployment. First, a worker loses their job because of the introduction of new technology. So the keyword is the introduction of new technology. And second statement, after Wall Street crash. So the key here, because of the crash, millions of Americans were unable to find work. And third, jobs in the car industry have been reduced due to strong union and high wages. Okay, high wages. So you have you can remember what kind of unemployment for the job loss under the strong union and high wages. And fourth statement is about the management accountant. Though the accountant has been made redundant, he can still find job in just 3 weeks' time. So it is a very short-term unemployment, or can we say it is unemployment? And the last statement here is about the bar staff. Bar staff are out of work in November in a holiday resort. So here, if you remember, we discussed about 5 types of unemployment. So for cyclical unemployment, fractional unemployment, structural or technological unemployment, seasonal unemployment, and real wage unemployment. So you can classify what kind of unemployment should fall into which statement on this. And second question, what type of inflation is in each phase describing? First, workers seek above inflation pay rises. Second, growth in demand for new homes are outstripped supply. Third statement, retailers have increased their prices in advance of inflation figures. And the last statement is copper prices have more than doubled on the world market, increasing the cost of electrical cable. So there's the 4 statements, and you remember we have 5 types or 5 phrases of inflation. First is demand pull inflation. Second is cost push inflation. And the third is imported inflation. We have monetary inflation and expectation effect. So under these 4 statements, you can name, say, it's quite easy. Say like statement B, supply outstrip demand outstrip supply. So what does it mean for in terms of inflation? And for like statement C, in advance of inflation figures. So you can see, is it the change because of the expectation? And for statements D, is about the cost. Okay, because the raw material prices increased more than double. So it's quite straightforward by understanding the statement here to match which type of inflation they are belonging to. And last question for this class is about balance of payment deficit. We discussed about the balance of payment deficit is coming from it can be solved by 2 strategies. One is expenditure reducing policy or strategies. The other is expenditure switching strategies. So here are 4 answers, and only one of them is expenditure reducing strategies. There are 4 options. First, the cutting level of public expenditure. So cut all the public expenditure in the economy. Second is devaluation of currency, is about exchange rate. Third one is the imposition of imported taxes or import tax. And the fourth one is about import quotas. So we have the expenditure switching policy, which is switch the consumers from buying goods from the imported goods to switch to the local domestic produced goods. It's the expenditure switching policy. And for expenditure reducing policy is the intention is just to shrink the economy, so it helps to improve the balance of payments deficit. So which answer for this question? Okay, remember what's the definition of expenditure reducing strategy, then you can answer this question quite in an easy way.